Just letting the last couple of people in, and then we'll get going. Okay, so I think we're good to go. So hi everyone. Just thanks for joining today's session. I'm Nicola McCormick and I'm the COO for Pro Manchester, and I'm delighted to welcome you to the webinar on managing lenders' property risk in a post-pandemic world. And this is being put on by JMW Solicitors. So before we start, just a couple of points of housekeeping. Be aware that the webinar is being recorded. Feel free to use the chat function to ask questions or make comments, or you're welcome to put up your virtual hand and we'll ask you to unmute yourself so we can take questions that way as well. Just keep your microphones muted, but feel free to keep your cameras turned on, because it's always nice to gauge audience reaction. So now, without further ado, I'm delighted to pass you over to our first speaker, Rory Dillon.
Hi guys, how are you doing? Right, okay, Nicola, if we can move on to that slide when you get a moment. Right, fantastic. I'll get going, shall I? So just by way of background for those who don't know me, I'm a chartered surveyor and LPA receiver, and I work for a company called Fletcher Chartered Surveyors. I also sit on the council for NARA, who are the trade body for fixed charge receivers. But as a good business, we also undertake good book development work as well and valuations. And it's with that that I'd like to speak to you today about what the 12 months ahead of us might actually look like. So to really understand where we are, I think we need to think a little bit about what is going on at the moment, what we're seeing on the ground, and then why some of these things are happening. And if you imagine that you are stood in the Lake District and you're on one of the hills and you're overlooking the Great Lakes there, dependent on where you stood, you might see different things. So at one viewpoint, you might see the road that goes down to the post office, go around a little bit further and you can see a small town. You go around a little bit further and all you can see is a great big hill in front of you, but the lake is always the same at the bottom. So for today, it's really about having that trip around the lake to get a handle on what is going on. So the first thing I'd like to discuss really is about the market. And I get asked all the time, how is the property market? And that is a near enough impossible question to answer unless you talk in averages. And the problem with averages is that they are just that. If you lie on the floor and put your feet in the freezer and your head in the oven, you'll be at about average temperature, but it doesn't really show you the extremities of what's being experienced at either end when it comes to giving you that average figure. So if we look at the property market, we need to think intelligently about this and break it down by sector. So we've got the residential and commercial sectors. We can divide this down again by subsector. So we'd say for commercial, we'd have retail, alternative, office, industrial, license and leisure, and then even further by investment grade. So we'd have prime, secondary, tertiary. And for industrial, you could go even further still. You could say sub 5,000 square foot, trade counter, mid-size, big box. And again, it could be manufacturing or logistics. And using that sort of average temperature analogy, the industrial market at the moment is the one that everyone says is the golden boy. That's showing the best rental growth and the best capital growth at the moment. But dependent on where on the lake you are, depends on how you perceive that. So industrial isn't always quite the sure thing at the moment. We are just developing a 40,000 square foot industrial unit now, and it's showing a negative IRR on the development appraisal. And that's because the build costs are outstripping what's happening on the rental tone in that area. So why is that being built, you might ask? Well, there's two reasons for it. There's speculation that rental growth will continue in that sector. But also in that instance, there is jobs being created in the local economy and it's situated on an enterprise zone. So if anyone has read Mervyn King's most recent book, Radical Uncertainty, the former governor of the Bank of England and who was in post during the last financial crisis, what he does is he challenges the reader to ask, what is really going on here? And never in time has this question been more important than it is now. We can talk about the pandemic, but what is really going on, that is only a skin deep explanation and doesn't really explain everything. I was on a call recently with one of the economists from the RICS, and they said that in terms of the movements in the property market, they've decoupled from what they would typically expect to see when the lead indicators are moving in the way that they are currently, those being employment, confidence, the manufacturing indices, for example. So why are house prices continuing to rise when those other elements are suggesting that they shouldn't be? And is that a phenomenon that's going to continue? And that is where the question, what is really going on here, needs to be unpacked. The RICS is currently struggling to forecast for more than a month or two into the future at the moment. And normally they would have confidence for up to a 6-month period or beyond that. So in terms of all this, I think throughout the pandemic, there's been some winners and losers. Some people have lost their jobs, but some people have actually saved a lot of money. They've deferred their credit card payments, mortgages, home loans. If they were working or weren't working, they might have been on furlough schemes. For businesses as well, they've deferred VAT payments, they've had suspended rents in some instances, deferred corporation tax, they've had CBILS and bounce back loans. The banks, which typically would have retrenched at a point like this in ordinary circumstances, have effectively shifted their loan books onto government balance sheets. And the big beneficiaries of that are the peer-to-peer lenders who were starting to show signs of distress pre-coronavirus. But now their customers have refinanced those loans away at cheaper rents, cheaper rates, and without personal guarantee now. Or so they think. And I do think there will be more to see on that score over the sort of next months and years ahead. So what does that look like for receivership over the next 12 months? The honest answer is, I don't know. And I don't think that anyone does. The market is totally distorted by way of government support. That is a fact. Who could have imagined a Tory government doing the things that they've done over the last 12 to 18 months? The removal of the stamp duty land tax holiday, which gradually tapers from the end of this month down to normal rates in September this year, will likely take some of the heat out of the housing market, particularly around the sort of £300,000 to £800,000 level. The conveyancing lawyers that we're dealing with at the moment are really struggling to get through all the work to get those transactions completed in time. And I suspect there's going to be some very awkward conversations between vendors and purchasers who don't make that deadline, because the difference between a sale happening on the 30th of June and the 31st of July is £12,500 in stamp duty, and that is payable by the purchaser for sales over £500,000. So what I don't think is there is any political will to see a cliff edge situation. You only have to look at the government extension to extend the moratorium to prevent landlords taking possession on commercial properties until March next year. And I'm sure James will touch on that later. And here I have sympathy actually for all the various stakeholders. We are currently acting on behalf of licensed operators who have not been able to earn a penny in Greater Manchester for 45 of the 52 weeks last year on wet-led license and leisure offers. And that is something which the funds who are based down in London, who weren't in tier 3, don't really fully appreciate that there was absolutely no way of making those properties generate income. And that particular assignment, it has been astonishing, really, the array of approaches from landlords in terms of how they deal with rent that's due from occupiers. But hardly surprising either, there is not a common approach. Some landlords, if they are well resourced enough, are doing complete rent forgiveness. Some are asking for maybe 20% of the arrears, but others are asking for the whole lot back. And that depends really on how you value your tenant, but also whether you are a PLC or whether you own your property through your self-invested pension fund, and the lender who you've got 60% with wants to know why you're not covering the mortgage. So for British Land and Hammerson, who are two of the largest propcos in the country, they are also one of the most shorted stocks in the UK at the moment. So how much to read into that is for experienced investors. But, you know, one only needs to look at the GameStop share price earlier on in the year to know this is dangerous territory to draw inferences at the moment. But just a quick point on some of the worst offenders throughout the pandemic. They have tended to be the larger corporate business occupiers, and they have, in some instances, really took advantage of withholding contractually payable rent even when they've had the ability or the cash to pay it. And certainly I'd expect the owners of the large shopping centres to have had a lot of experience of that. Now, James Timpson of Timpson Shoe Repairers very eloquently wrote in the Sunday Times this weekend that there are three parties in this relationship. There's the landlord, there's the tenant, and there's the good old business rates system, which is antiquated and broken. And I think that when the business rates holidays are removed as well, this will cause further pressure on the property sector. So in terms of the receiverships themselves, I think there is unlikely to be a huge deluge of them this year. My colleagues on the Nara Council seem to be in broad agreement with that, but none of us have got a crystal ball. I don't think there is a political will, and I also don't think that whilst the sun is shining, lenders will want to see how things play out for the time being. But it's interesting doing the work that we do at Fletcher Bond because we have exposure on both sides of the fence, in the insolvency and restructuring community, but also on the development side. And that is good because it keeps us grounded. We get exposure to many points of view rather than being stuck in the echo chambers of doom and gloom with the insolvency practitioners or the complete unfettered optimism with those world-beating developers. Now, one thing that does need to be talked about, though, is build cost inflation and the availability of labour. And no matter how optimistic one is at the moment, that has to be a concern. And it doesn't really appear to have hit home for some of our more professional colleagues at the development and design stages at the moment. But when you actually go to the Gemba and you speak to the guys who are in the brew room on site, this is a real issue. Some timber's up 80% this year. Steel has risen 30% last month. D&Q are rationing bags of plaster to 2 per customer, and there's workmen driving all round cities trying to get the materials that they need. Steel is becoming harder and harder to get hold of to the extent that we could run out. And to think it was only a few months ago that the official receiver was shutting down good old British Steel in the northeast. We had one case where the builder on site told us that an extremely modest amount of insulation that was on site was more than the representative for the manufacturer had in their entire warehouse at the time. And that was only 2 weeks ago. These warehouses are empty. And what this is causing is panic buying and even speculation, because rather than working on the sort of just-in-time model, contractors are placing entire orders for their full project to secure the stock at the outset. And now merchants are also asking for that, are insisting that they will only supply to them on those terms as well. What they are doing, though, is storing some of those materials for the purchasers. But all of that distorts the developer's cash requirement and it exacerbates the demand position for materials too. So why is this happening? Well, there's two things really. COVID is part of the reason. The shutdown of the factories, so British Gypsum being one of them for plaster, but also the complete mismatch in expectations for demand too, coming out of the pandemic and what people thought was going to be a very severe recession. No one foresaw this much demand after the world economy shut down. And that's meant that suppliers just haven't been able to keep up. And it's not just in the construction industry. Heineken, the international brewer, have not brewed enough Moretti to keep up with demand for their customers either. And I believe they're rationing it to 3 barrels per publican customer. So on the labour side, this again draws parallels with what I saw in 2006. And the bricklayers at the moment are earning up to £240 a day, so roughly £30 an hour. And that's the best part of a 60 grand a year job. So that's probably better than a lot of professional occupations are being paid with far less university fees. And good luck to them. Plasterers, £180 a day. And when you actually go on site and you speak to these people, the lads are picking and choosing now which sites to go on. So they might start on a job on a Monday. There's nothing wrong with the site, but they will move to another site for a higher hourly rate by Wednesday. And what that's doing is causing spiraling wages, build cost inflation, and deliverability issues. So the big issue that we will face is what happens when all these projects that are partway through begin to run over budget. And with that, I suppose my particular concern would be some of these larger high-rise development schemes around the city centres. They are already asking for extensions of time due to the pandemic. But if you have a fixed price JCT contract for 12 to 24 months, for example, and you're halfway through now, how are these contractors going to honour the commitment that they've made to the developers? And I think the short answer is they are not. They are going to have to come up with a way of finding more money. So they will either absorb the costs themselves, which are there if they are able to, but it is probably unlikely, or they could potentially go bust. So while the developer is looking at some rising values and hoping that they might save the day, it's not a certainty that that will get them out of the trouble that potentially could come with the increasing build cost rises. And if a development is forward funded, which is traditionally a way of de-risking a development, then all of a sudden now your risk is now in deliverability, and the risk is transferred onto the developer again via his contractor if they cannot take the pain of the price increases. So I won't talk now about my views on the build to rent sector or the huge amount of development being done in city centres at the moment. But what I would say is that dependent on your view of the lake, you will either see a total mismatch relative from a supply side relative to demand, particularly given that the pandemic has now led to a race for outdoor space, or alternatively, what you will see is thousands of new home offices in the sky, surrounded by all the attractions and benefits that city centre life has to offer. But timing in property development is everything. So what next and what to do? I would start by saying that whilst the pandemic is unprecedented, the market moving in cycles is certainly not. It is possible to be defensive through the downtimes and still prosper. There is still time to put strategies in place if your business needs it. And that is what we at Fletcher Bond are very good at doing, working with our clients, lenders and propcos and developers to undertake meaningful restructures which prevent business insolvency. So what I would say in terms of that is, if I could leave people with one thing here today, is that the earlier that you act, the higher the chances are of having a successful restructure. Installing someone like us doesn't have to be a terminal situation. Our job is to fix things when they go wrong, but we really need to be getting involved on the early warning signs when lenders are having issues with customers. So whether that is through less frequent communication, sales falling through, the development program falling behind, cost overruns, that is the time that we can have a conversation to establish what help the developers need and to protect values. So one of the sort of big criticisms that I have of our industry really is that it's very easy for colleagues to look at a distressed situation and take a very scientific approach to it after the event with the benefits of 2020 hindsight. But at Fletcher Bond, because we undertake development work ourselves, we understand that when decisions are made in the heat of the moment, people don't take a scientific approach every time. They take a social one. They react badly to losing sales, or they retrench, and they don't communicate when things are not going so well. They have a tendency to do the exciting bits of the job and leave those dull but difficult tasks to the last minute, and that can end up causing problems. And what we try to do as a business is to get into the middle of all that and create a safe space between the lender and the customer to understand what those issues are and focus on fixing them. The postmortems can be done afterwards, but in a race against the clock, people need plain English solutions to get them to the point that they wanted to get to at the outset. So that's all from me, and thank you very much for your attendance today. And I hope this stirs up a bit of interest. Ask some questions at the end, and let's continue the conversation. Over to James now for the legal view, and he can give you a good insight into where he thinks things are going in the next 12 months. Thank you.
Thanks, Rory. Really interesting talk. In particular, stock held off site, not rent going unpaid, and I think a key theme that's going to come out in my talk now, which is acting early and communicating. So I'll pick up all of that as I go through. But yeah, really good points. So I'm James Williams. I'm a partner here at JMW Restructuring and Insolvency team. I work on all matters in restructuring insolvency, but I do have particularly good experience in property insolvency. I make the point to say, you know, I always do make a point of saying that I work on the whole job, whether through reservation of rights or amend of restatements, through the enforcement, through the asset realisation, and then possibly to look at director claims or to pursue people under personal guarantees. And I always make that point because I think that looking at property risk in isolation and without looking at that journey all the way through leaves you at a disadvantage, because when you're at the start of the job, or you're at the start of things going wrong with the borrower, if you can look to the future and draw on your own past experience as lenders, or experience of your lawyers or your insolvency practitioner, you know, you can often identify the type of borrower, what he's going to do, what approach he's going to take to things. Is he going to be very argumentative? Is he the type that's going to be cooperative? And seeing where the trajectory can go means that if you can do things early on, you can cut down costs and time to money later on in the process. So, I mean, the theme of the presentation is to managing lenders' risk in the post-COVID world, and a lot of what I'm going to say is just generally managing lenders' risk, because as Rory says, you know, there's business cycles and people have all been through it before, and the things that you do to mitigate those risks don't really change. There's a couple of quirks that are thrown out by the COVID experience we've had, but by and large, quite a lot of what I'm going to say is best practice. But what I will try to do, I'm not just going to give a presentation about legal documents. I'm going to try and draw everything to practical experiences of how you can actually implement measures to mitigate risk. So, just before I jump into that for the first slide, I think looking at what the risks in the post-COVID period are, I think it's going to be a lot of litigation in future. I think there's a lot of things that have happened in COVID, like informal interest payment holidays. There's a lot of government measures that have been misunderstood by both lenders and borrowers, and the documents just weren't set up to deal with it. And perhaps the lender systems weren't set up to deal with a situation where you had a complete mass of borrowers all doing the same thing, all making the same requests. So I think that just leaves so much scope for litigation down the line. And right now, if you're worried about that, is the time to do something about it. So the first slide is about legal documents. I'm not going to talk about the legal documents in much detail. You know what they are. You know what your legal suite of documents is. You know what standard security you're expecting, and you know what CPs generally there are in your documents. But what I would say is that just a reminder that there is deal fatigue. There are last minute complications to deals. There are things like a rush to beat stamp duty, a rush to beat the C-bill deadline, that just mean that CPs are waived, CPs are missed, CPs become conditions subsequent. What you need to do is you need to look at the lender, the borrower in question. Does the security look right? You know, first question, does the security look right as per my standard suite of security? But then delve deeper and have a look at the CPs and just get an understanding from the file of, was there a rush on at completion? Did something move to a CS? And then was that followed through on? In particular, so one of the things that quite often see is that there'll be a condition precedent for a deed of priority or something like that. And a deed of priority, a deed of subordination are quite often the most complicated and most negotiated documents within the security suite. And what that can mean is that your term sheet that you might be looking at as a reference, or the CPs that you're looking at the facility as a reference, might not actually marry up with what is in that intercreditor, because maybe it changed with consent over time, and completed with the lender fully in the picture, but it wasn't recorded properly on the lender's file, or perhaps it just wasn't understood and documented properly by the lawyers. So it's about looking at the suite, looking at the CPs, but then for things like, important things like intercreditor arrangements, delving that bit deeper yourself and having a look to see whether that document actually reflects what you think it should. As a lawyer, I'm going to always recommend that you should consider a security review, and that the earlier you consider it, the better. So in standardized security packages, you might wonder whether that's really necessary, but what they do allow is for us to look at and identify issues in the security early, but also, a good security review done hand in hand with the lender and listening to the lender's issues, we can really tailor it to address, case specific things. So has the borrower's son gone into possession of one of the properties? Is he now living there? That to me starts to look like an early warning sign of a borrower strategy to delay enforcement. Was there a planning issue revealed in the report and title? Yeah, okay, you might have search insurance that covers you for that, but practically speaking, on an enforcement, that's something that an office holder is going to have to deal with, and it might mean that there's time to money issues. And again, if we can identify that early and work hand in hand with you on the security review, then we can try and come up with a solution for that early. It depends where you are in that borrower cycle. If you're mid-development and they keep, they still want more money from you, they want more drawdowns, then it's possible that we can do something, whether it's an amendment to the facility, amendment restatement, or a standstill agreement, that just puts us on a better track when it comes to that enforcement situation a bit further down the line. The theme that Rory picked up on, which is, act early, act preemptively if you can. I do recognise that, we don't live in an ideal world where you have one RM for one borrower who can just manage that. You have case portfolios, but it's not always possible. But ideally, if you can identify a situation early on, and you can actually avoid a default situation, restructure the debt, restructure the loan, and put right any issues that you might have identified in a security review, that's going to be it's going to be a really good thing to do. In COVID, as Rory's mentioned, we've got bill cost inflation, we've got shortages, we've got borrowers stockpiling materials at warehouses. Well, that just that rings alarm bells for me as a legal advisor in relation to your security. So there's a drawdown happen. You've bought several tons of bricks. Those tons of bricks are at a warehouse somewhere 100 miles away, and your office holder turns up on site and says, "Where are the bricks? We paid for them, but they're in a warehouse." Well, who owns them? Where's title vested? In a world without insolvency, you would just get them delivered. But who's to say that warehouser doesn't go into an insolvency, or the supply goes into an insolvency? You have an argument about stock. So it's about thinking about things like vesting certificates when you do drawdowns. You have a document then that says that the title to these goods is vested in X, Y, Z, and is subject to the security, etc. So if I could move to the next slide, Nicola. So now we're sort of in the territory of default. You're either just about to go into it, or you are in it. The key message is to control communications, and I know, as Rory mentioned, people aren't analysing these things in the heat of the moment on a scientific basis. They're acting emotionally, but to manage your risk as lender, you should try and keep a control of communications. You don't know where this borrower connection is leading. Communications, they start quite good-natured. They can fall into being quite casual. I recognise that that's inevitable, but what it leads to is that when you look into enforce later on, these emails, these undocumented conversations, in 18 months' time, when you're trying to enforce your security, and you need to, because there's some sort of time pressure to do so, the borrower will raise these communications, and the benefit of the doubt in them, they will always make the most of it. If there's any doubt in the communication, it's in their favour. The borrower will just make a big deal of it and a big play for it. So they'll say, the default was waived, that you haven't needed us to comply with the drawdown requests for the last 18 months formally, so why are you suddenly asking to do it now? So we've got a convention that you just give us the money when we ask for it without any checks. And so, it's putting pressure on you as lender to think, well, actually, if we don't advance this money, and the whole scheme collapses, are they going to make a claim against us? Whether it's spurious or not, it's time, money, it's hassle when they make that claim. I've even seen it on a couple of occasions where the communications between the lender and the borrower are such that the borrower just creates an argument to say that a brand new loan agreement exists with no terms, and you sort of think, well, that's crazy. That's how could you even possibly argue that? But they do. So it's just one to watch out for, because it's time, it's cost, it's possible delays to enforcement, it's distraction for you later on when you have to deal with it and go through all your emails and write up case notes. It's a distraction for the office holder. It can even lead to people challenging the office holder's appointment because they say there's no default or the debt's not due and payable. And it can I've even seen it where it distracts the administrator because the borrower says, well, actually, look at this dossier of documents, this dossier of communications. You should actually, on behalf of the big company, be suing the lender. And it's a big distraction when what the office holder is trying to do is to realise the asset for the benefit of creditors. So yeah, it just costs. Informal communications and ambiguous communication can really cost you time and money later on in arguing about things. So just turning to the actual slide, it says control communications, keep a record of meetings and telephone calls. Ideally, you'd have 2 staff on any important calls and meetings. Definitely send formal emails following up what was discussed. And just, be careful of experienced borrowers and defaulters. And it might be that, your borrower is ultimately owned by somebody who's married to somebody who was bankrupt in the past, and that it's sort of orchestrated through that. So that person might not come up on your checks at the outset of the loan, but it's just having a mind to the fact that there are some experienced borrowers and experienced defaulters out there that know what they're doing and can lead junior colleagues on the lender side into a bit of trouble on those communications. Finally, reservation of right letters, that really good thing, should be sent. What they do is they identify the default, obviously, but as well, just practically, they're quite often a good marker in the sand with the borrower to draw a line on the past and say, well, actually, we were working together at this point, and we want to continue to working together. But right now, here's a formal letter from us telling you that you're in default and that these things are going to be treated quite seriously from now on. Nicola, if I could have the next slide, please. So just one final point on reservation of right letters. It's just not just reservation of right letters. There's a lot of things happening right now, like interest payment holidays, informal payment holidays, where the borrower is saying, well, I can't pay because my tenants aren't paying. Well, these are actually a good opportunity. So if you've got your reservation of rights letter out there, you've obviously got your default. But now is the time to look at, is there something you can do to remedy perhaps an informality of the past? So you've got an informal interest payment holiday. You know, you look at the communications, the emails, and you're not quite sure when it's going to end. It just sort of says at the end of lockdown. It's been, you've had a waiver of rent for one period, then he's paid a bit, and then there's been another waiver. Well, at this stage, quite early on, it might be a time to formalise that and to enter into a proper standstill arrangement that says, look, you've had this standstill in the past. It definitely comes to an end on this date. You've said that you can still repay us on the repayment date, or you said that, you know, you need an extra 6 months to repay us. And as part of that standstill, what you do is you insert an agreed debt and interest figure as at a certain date, so that, you know, there can be no argument down the line that the interest was waived and it wasn't recoverable, because that's something that I think is going to come. Some of these agreements I've seen to waive rent, what the lender really means is that you don't have to pay me rent for 6 months, but in 6 months' time I want my rent paid. Now the question then is I want my interest paid. The question then is, in 6 months' time, is the borrower supposed to pay a lump sum of past interest? Or is he supposed to pay it on the interest payment dates? Or has it just been waived? It's not recoverable. That's certainly an argument I can see them trying to make in the future. So yeah, now we're in an enforcement situation just prior to enforcement. A pre-enforcement review is absolutely key to the future strategy. And what enforcement methodology you use. So this is looking at who the borrower is, how he's going to react in certain situations, where your stock is if you're dealing with a site with a load of stock or building materials, who are the other secured creditors, who are the other stakeholders in this, what is the status of your legal documents and what's your legal advice on those documents, what do your estimated outcome statements say in relation to different enforcement strategies? So that might be build out or just immediate sale, but it also might be different methods of enforcement. So you might have an EOS for a receivership, an EOS for an administration, you might have an EOS for enforcement of a share charge, which I'll come on to. One thing to think about here at this pre-enforcement stage is that what is the effect of the COVID on that strategy? So is there going to be lockdowns? Are there going to be lockdowns in the future? Are there going to be shortages of stock in the future? Who's going to fund that? The problems that can give rise to. So you quite often see development sites where there's a couple of houses done, they sell them, they use that money to build the rest of the houses. Well, if you can't get the stock and you can't get, there might even be a shortage of buyers after the end of this stamp duty holiday, at least for a little bit. How's that going to impact on that enforcement strategy? And does the lender need to think about putting an expense loan to the administrator, to the receiver, just to allow funds and that flexibility to be able to react and preserve value. As well, just particularly a receivership, if people aren't paying rent, they're not paying service charge, how is the property going to be maintained during that period? You know, you've got a problem with the roof, where's the money going to come from? So that's something that needs to be thought about. I think, like I say, on every job, but I think in this COVID period, it's probably something that really needs to be thought about in advance of the enforcement. Share charges, just wanted to talk a little bit about these. Most security suites will include a share charge, but you know, they're rarely used. They're rarely used because, to be fair, they don't normally fit. They don't fit a lot of situations, or the lender doesn't have the appetite for the risk, because the enforcement of a share charge is a little bit more risky. But what it means is that they're quite often not taken properly. Things like the articles aren't changed to reflect the powers of the lender to just become the shareholder automatically without direct consent. The share certificates, physical share certificates, are not actually obtained, and also the drafting of the share charges might not be very good. I could talk quite a lot about that, but I probably won't. But associated documents like the deed of subordination, if you've got a share charge and you're enforcing it, the last thing you want is the old shareholder's debt still remaining in that company. So it's about looking at the deed of subordination hand in hand with the share charge and thinking, well, actually, can I enforce under that? Because it does deliver sometimes a significant upside. It does allow the lender to take advantage of certain tax points that might be beneficial to it or a future purchaser in a development site. It does, if for example the lender wanted to just take the property, develop itself, and run it as its own investment, you know, it would cut down on stamp duty. You wouldn't have to pay the SDLT, stamp duty land tax. I mean, there are risks. You know, you have to change the board of the company that you enforce the share charge over. It's probably, you know, it's going to be more litigious than just a simple receivership enforcement, but then the upsides might be there. So it's definitely one to consider. There was an announcement out a couple of last week in relation to dealing with rent arrears built up during the COVID period, and the government has announced that there's now going to be a mandatory arbitration scheme to deal with that rent. And I just think that's a really interesting point in relation to this share charge enforcement. So what you normally see is that you enforce over a property, the property, the tenant's not been paying rent or he's not been receiving rent. And that when you sell that property, we deal with the rent issue as a balancing exercise on the completion statement. So if you owe a load of money to your landlord, the buyer will pay consideration less that money so that it can settle the arrears with the landlord. Now, when you put a mandatory arbitration scheme into that, and admittedly we don't have a lot of detail about it, but it seems to me that the arbitration scheme is going to do a couple of things. It's either going to write off some of that debt built up during the lockdown period, or it's going to give time to pay that rent built up in the lockdown period. Now, if you're the borrower, so I'll just presume that the share charge can be enforced and you're in the shoes of the borrower. Well, giving a purchaser a discount on the purchase price to settle the landlord arrears starts to look a bit difficult, because you might not have to pay them under the arbitration scheme. So you might be giving away something that you don't need to. As an office holder, so if you're an office holder and you're selling one of these properties and you give a discount on the purchase price to cover the rent arrears, will somebody sue you in the future because you didn't explore the possibility of arbitration? I think the devil's going to be in the detail on this arbitration point, but it's going to throw up a lot of questions. There's some IPs in the audience. How are you going to value a company where its biggest liability is subject to a mandatory arbitration? It's difficult, isn't it? So watch this space for that. We'll see what the government comes out with. Nicola, if we could go to the next slide, please. So recovery, I've not got an awful lot to say about this apart from if you're a lender, you've ran a marathon, you got to the end of the race. Don't take your eyes off the ball when it comes to actually getting your money back. I've seen a couple of really nasty cases where the release of security has been mishandled by people, by their solicitors actually in one case. But it's things like getting your redemption statement right, including everything that you can in it, making sure that you've made demand under your guarantees if you're going to include that on your redemption statement, making sure your solicitors have got proper undertaking to receive all the money, because that's something I have seen where there's been multiple sources of funds, and I think we're going to see a lot of that in the future. It's not just going to be another bank taking somebody out. It's going to be another bank. The borrower shell, they're putting in a bit, might even be something coming in through plot sales in the meantime. So you might have 3 sources of funds, but you've only got 1 release of security. So you just got to make sure you get it right, because once you've released your security, you're just chasing the borrower for a debt, and you don't want to be in that situation. And finally, just picking up on a bit of theme of litigious borrowers and how it might become more litigious. When you do a deed of release, you can make it a mutual release. There was actually a case on it came out the other week, which the borrower had threatened the claim against a lender, and the lender refused to release its security because under the terms of that security, it was covered for any threatened claims against it. And the lender said, well, I'm not releasing my security until you drop the threatened claim. Could be quite a powerful tool. It definitely gives a bit of a finality to the relationship between the lender and the borrower. And it's something that you should really be thinking about as we move forward. Final points. Will there be a post-COVID period? Don't know. I hope so. But I think that these lockdowns, mini lockdowns, bits of restrictions, the difficulties that Brexit throws up in supply chains, they're going to be with us for quite some time. So it's just about having your processes in good order and following them and seeking advice from people where appropriate. I've not got anything more to say now, so if we want to deal with some questions, we could do that.
Right, I'll start us off. John Jones, do the panelists think communication or dialogue between property owners and agents and tenants has improved, worsened, or stayed the same during the past 15 months, and how do they think this might go in the future? I think the first thing I'd say on that, John, is when we look at this and talk about COVID, it's very easy sometimes to look at all the downsides of it, but there has actually been some positive things that have come out of it too. I think in terms of how we communicate, that has completely changed. Obviously the adoption of Teams and Zoom and all that kind of thing, but we also it's acceptable now to speak to people, almost any time of the day. Now, some might say that's a good or bad thing. You can hear children in the background, and they're animals. Things have changed an awful lot. And I think, to sort of answer that question, you can't give a one size fits all answer. It really does, as everything in property does, it depends on the people. And it depends on how the relationships are managed. And, if you are clear in your expectations about what sort of communication you require, then hopefully the other side will respond to that. And if they don't, then you need to work out a way that you can communicate with each other so that you can get the desired information. And I know certainly that's where sort of we as a business sort of sit in the middle, because we've got the finance people who speak the language of finance, and then we've got property people who are speaking about property, and they don't always translate. And we kind of sit in the middle to explain, right, on the ground, these are the issues that are happening. And, you know, but from the lender's perspective, this is what they need. And this is why they can't support this through a credit process or whatever. So I think it overall, I would say it's probably a bit of both. Some has absolutely deteriorated, and there are, you know, some customers out there who are completely taking advantage, have gone off the radar, but have been, you know, beneficiaries of bounce back loans and all the rest of it. On the other side, we've got cases on at the moment where we've seen people literally working night and day to get the problems resolved. We redeemed an LPA within 4 weeks. It's the quickest one that we've ever done, where we got £1 million back for the lender. And this particular individual was corresponding with us at 2 o'clock in the morning. But, you know, we worked very closely with them to explain what they needed to do, help them through the process so they could get it into a financeable state. But that was the best result for them. They continued with control for the property. We were happy because our client gets the best result. So, you know, I think that in terms of communication, it is very sort of balanced. And the only other thing I would say on that is, you know, in terms of, because you mentioned about owners and agents and tenants, I would say that the balance of power, you know, has certainly swung in the tenant's favour. You know, what we are seeing as well is pandemic clauses now being put into lease renewals or new leases, so that if there is, as James mentioned, you know, we're not out of the woods with this yet, but if there are, you know, further lockdowns or whatever, then tenants are reserving the right to have it put into their contracts that they will pay a prescribed level of rent, and that might be, say, half, maybe less. So I think, you know, things have changed, and in some ways, as I say, it's very easy to say it's all got worse. It hasn't. There's been, you know, some really positive things that have happened out of it as well. Overall, I think it's one to watch. In the future, I think it's all about people and how we manage those relationships with each other.
I think that what it has done, like all structural problems in an economy, like what happened in 2008, is it's brought. There's always an underlying current of things going wrong, in development. Otherwise, in sort of restructuring insolvency, we wouldn't ever have a job. But what we'll see now moving forward is that there's a lot more people brought into that dialogue. There's people who wouldn't normally, wouldn't ever have expected to find themselves in an insolvency situation, or having really good developers who've done 5 projects in the past, small scale, but they've always come off, always been honest, always looked after people. And they might find themselves in a situation now, whether it's COVID or whether it's the effects of the aftermath of this stamp duty holiday, where perhaps nobody wants to buy anything for a few months. It's going to cause problems for people, and it will just draw more people into those conversations. And as for whether the dialogue's getting worse or better or not, it's all based on personality as to how they react. Sometimes they stick their heads in the sand, they react very badly, and sometimes they don't stick their heads in the sand and just make your life an absolute misery in terms of the communication you got with them. But I think there's just going to be more communication with people in distress situations, which is going to give you that full range of dialogue.
Yeah, absolutely. We've got some clients who only send us WhatsApps. Things are completely changing, or they might be working abroad, and you'll get, messages from them very sort of late at night.
Yeah, that's a lender risk. That's a lender risk issue, because it is quite easy to drop into texts and things, but what that does is it opens up. That's all disclosable, and it becomes quite strategic, I think, when you're trying to defend a lender, and the borrower says, well, I had several texts with him, so I want to see all his text messages. And actually, I want to see his text messages with his boss now, because that is something that I think should be disclosed. And there's probably nothing in it, but nobody likes lifting the skirts, and lifting the skirts on a load of text messages is not something that most people would want to do. So it is about managing that communication and just being quite careful, and especially with the borrower, keeping it as much as you can. Practically, I do it myself. We end up texting and things with people, but it's one to watch that, because that's all going to become disclosable if you end up in a big fight about it.
And just another question here from Nicola about which sectors of the market do you think will be most impacted over the next few months? Again, a very difficult question to answer that, really. I think the development side is one to watch, but genuinely, I don't know if we are on the cusp of going through a mini boom, because we have got so much government cash coming in from all directions. And if you speak to the developers, as we do, that some of them are extremely enthusiastic. I think the issue is going to be on the supply chains, labour, and cost of materials. And at the moment, what it is trending towards is that the rate of increases for materials is not being tracked with the rate of increases in capital values. So that has to lead to either decreased profits or schemes becoming unviable. But that's, out of necessity comes invention. And what will happen is that, the bricklayers who are earning 60 grand a year now might not be able to do that in 5 years' time if modern methods of construction and prefabricated buildings start to really advance. And, the big pension funds are all investing in this at the moment. I do think that will draw sort of construction costs downwards, but in this immediate term. And, I think as any property business, they should think strategically and more long term, but they tend to think in the sort of what's happening in the next 6 to 12 months. But if you sort of do your horizon scanning and think about what's going to happen a long way in the future, that would be a big game changer, I think, for how this sort of housing delivery is dealt with in this country.
Perfect. That's brilliant. Thank you both so much for that. That's been really insightful and really, really useful. So huge thanks from me to you, Rory and James, and thanks to everybody for tuning in today, and hopefully see you at the next one. Thank you very much.
You're very welcome. Thanks. Keep in touch, guys. Cheers.
Bye.